The thesis, though, was my downside's pretty much protected. The odds of it going to zero
are very, very small. I mean, some of these bonds were paying, a quarterly coupon of like 1 point. You can buy them for 5 points, which means unless the whole thing blows up in the next 4 quarters or 5 quarters, you're making your money back, and then it's all free upside. And the one thing that I was extremely confident in is that nothing in Europe happens that fast. So if it's not going to, it might blow up, but it won't blow up in the next year, right? And so that meant your downside was not in every one of these structures, but you do enough of these bets, and if you put 10 on, and you're going to be right most of the time, you're going to make your money back and have this great free upside, which generally then, as I progressed through my investment career, is, at least in my mind, the secret to great returns is having a very good free upside built into whatever you're doing.
I have to say, I met Simon at Reconvene in LA. And I remember Moses was like, hey, you got to meet Simon. And at first I saw you, I was like, I really like the logo on your shirt. And we kind of talked about that. And you kind of told me what you did. And I was like, oh, that's cool. But you were very under the radar. And I was like, so what are you doing later today? And you're like, I'm actually speaking on stage. I was like, okay. Then you spoke on stage and I was like, holy. So as soon as I saw you after that talk, I was like, you didn't tell like 95% of the story. So we're going to get through some of that story again today. So I think a good place to start would just be growing up in Germany and making your way to America.
Sure. And thanks for the intro. That's mighty kind. So I was born in a small town to the east of Munich in what then was West Germany, not far from the Iron Curtain, which at that time was a little bit sort of the end of the known world, as I've called it too many times at this point. But it actually was, right? That's where the train tracks ended and the road ended because you just couldn't go to the other side. Really small place, 800 people, elementary school where you knew everyone, you knew every person's dog's name kind of place, you know what I mean? Where to this day, sometimes when I walk into a shop or something, they know who I am and I've never met them, but I look like my father. So they're like, you're Simon. I'm like, really? Like just, that small of a place, right? And I lived there until I was 16 years old. And I think it was about 2 weeks after my 16th birthday, I moved to the US. It was one of those high school exchange programs where you come and you live with a family for 1 year, go to the local high school, and it's just complete luck of the draw where you end up, right? Could be anywhere, 50 states, anywhere. Those people don't get paid or anything, so it's a total volunteer-based thing. And most of the people that do it because they themselves, either they don't have kids or their kids have moved out or they've been doing it many, many times. My luck was that I got placed with a wonderful family in Virginia Beach, Virginia, who've been doing this for years. That had year after year, they took in a kid from somewhere, usually Europe at the time. And I lived with them. I was a junior in high school there. And after that year, which was a really good time, I went back to Germany and I went to school for a single day. I came back home and I called my host mom, foster mom, whatever you want to call her, Sylvia. And I said, hey, Sylvia, you mentioned I could possibly come back and we'd work something out. Is that still on the table? Like, because this really sucks. I don't want to go back to this. Not one more day. All right. And she said, yeah, sure. And it took a little while for us to find a solution because the visas are such that you can only have a student exchange visa for each level of education for 1 year once. So that wasn't all that straightforward. But what we eventually settled on is that they would just adopt me. So Sylvia and husband Bernie adopted me. And that's how I then managed to finish high school in Virginia Beach. And because they adopted me, I was legally at that point then their child. I was able to go to the University of Virginia on in-state tuition basis, which is what I then did thereafter. So,
how common is it that somebody would foster parent somebody abroad? Is that a common thing, or was that a unique situation to you?
So it's relatively uncommon. I mean, again, the taking a kid in from overseas and have them live with you for years. I mean, that's already uncommon. Most people don't do that. I mean, again, they don't get paid or anything for it. They just do it because they're good people. But within that group to then, remain, be adopted and so on, I'd never met anyone else who's done that.
It's unbelievable.
So that was, that's how I ended up basically staying in the United States.
Okay. So you go to UVA and then what happened?
So UVA, aside from being the only university that accepted me, also is a wonderful school, and they have a great undergraduate business program. I did a whole bunch of things there, but amongst others, went through that undergraduate business program, which has good relationships with several Wall Street institutions. They have a career center. You do all these interviews, all this prep stuff, all this jazz. You go through it, and in the end, I got a job with Morgan Stanley in New York to work. Well, at first, you just get placed in a general pool of people that they hire into their sales and trading program at the time. Within that, then I managed to network myself into what was then considered the really hot and cool area of the financial markets, which in 2006 or leading up to 2006 was when I started, was structured products, mortgage bond trading, essentially. So that was my next step then.
And that wasn't your first foray into finance, because you were buying bonds when you were like 8 years old.
Yeah, that's right. So I, as I said, I grew up in a really small town where there just wasn't that much to do. We didn't have cable television or anything else. So you could either take a ball and kick it around a soccer field, or you could go to, the gas station, buy some chewing gum, or you could go to the bank. And so I went to the bank quite a lot. I would just hang out there and read whatever materials they have lying around, and occasionally buy some kind of investment product, which clearly at that point I couldn't legally do. But they, again, being a small place, they basically just had my dad's signature on file, and they would just let me do whatever I wanted them.
Yeah.
So yeah.
All right. So fast forward back. So you get to Morgan Stanley. Describe one more time the department that you landed in.
So the department was, at that time, most of the big Wall Street banks had what they called a client-facing side, which is essentially trading with customers and facilitating lubricating the financial market, so to speak. And then a separate department was trading on the bank's own balance sheet and taking risk for the bank. Not that the guys who did the customer-facing trading not do that as well, because everyone at that time took whatever risk they could, because that's how you got paid. But we didn't serve customers in the department that I was in. You were a customer of Morgan Stanley and other Wall Street banks, similar to as if you were a hedge fund that was completely outside of a financial institution. The main difference between that and a hedge fund was that you had the balance sheet of the bank to fund you at an extremely attractive cost.
Yeah.
So, yeah.
And will you describe real quick, what does lubricating the financial system mean?
So what banks historically did, and what they do now again, is if I have a position in some financial instrument, in this case bonds, I need to sell it to someone. Someone needs to buy it from me. All of that is still to this day done on a over-the-counter basis, which means you pick up the phone, you call around, you find someone to buy them from you. And the banks would basically buy that position from you if you want to get rid of it, and then find someone else to sell it to. But for a period of time, they hold it. So in that sense, they're different from a broker. They're called market makers. So that's what the lubricating the financial system is. And because you hold them for a period of time, you do take some risk. But then again, the group that I was in was only taking risk. So there was no even attempt to make a margin or a spread as you would on the market maker side.
Okay, so it's 2006.
Yep.
You joined what was like the hot team.
Yep.
And were they doing commercial mortgage-backed securities? What was the buzzword?
Every type of, they called it structured product, but the biggest was commercial mortgage-backed securities, residential mortgage-backed securities, oftentimes subprime, CDOs, CLOs, aircraft leasing securitizations, credit card securities, you name it. Like everything was securitized at that time, right? And the more layers of securitizing you could do, and the more complex it would be, the more you got paid to do it, essentially. And the more risk you put on, the more you got paid, right? Because
as a young person, when you were watching it, was it dawning on you that was the case, or is it only in hindsight that you were like the more complex, the more risk you took?
Look, when you start in a seed, and I don't know if that's still the case today, I suspect oftentimes it is. You start in a seed like that. It's not like you get a big training before, and yes, you have 2 weeks of training, whereas, this is how you turn on a computer. Here is how you get your badge. Excel works like this. Add these two cells together, and don't say these things on email. Right? That's your training, right? And then you get sat down on a trading desk next to some guys who've been doing this for 20 years, and they give you a clipboard. At that time, you got a clipboard and say, "Hey, record my trades." You're like, what? Shut up, record my trades, right? Yeah. And you're like, oh, I'm just going to get going here. And it takes you quite a while to even understand what the hell's happening around you, right? Like, there are all these hand gestures, and not that I worked in the pit, but still, there's a lot going on the trading floor. And as you develop a bit of a sense of that, you hear things, and sometimes they don't make sense, and sometimes you just can't work them out. And it's only later really that you can really pinpoint the ones that never made sense, or you just didn't get them at the time. But there were definitely moments where you look back now and you're like, wow, someone told me about this, and it seemed like such a dumb thing to do at the time. Yeah. But obviously you didn't say a word, right? I mean, you're the new kid, and here are the people who've been doing this for all their lives. They know what they're doing. You sit there and listen, and you're trying to figure it out. And then 10 years later, you still haven't figured it out. And you're like, okay, it was actually a dumb thing. Yeah. Right? So,
all right. I'll preface it by saying it wasn't you that caused this.
No.
But if you go to Wikipedia, the team that you sat on has a world record. You're in second place for the biggest loss ever taken on a trade. It was nearly $10 billion.
That's correct. Yes.
Which is now teeing up what's about to become a wonderful story.
Yes.
So you're still young, you're fresh, you're green blood on the team. When did you start seeing that something was massively wrong?
I mean, this was about a year into it, right? So in 2007, the subprime side of the business started taking real big hits. And the interesting elements about that billion loss is actually, there was a guy on the team who made 6. This is the net number, right? So it would have been 15 otherwise, or almost 16.
He made 6.
He made 6, right? And that started earlier. So at first, those direct subprime shorts that this small team or the sub team within the bigger team had on started making money. And you noticed that something was changing, because not that you couldn't see everything everyone was doing, but you would hear what was the daily P&L. And all of a sudden, the numbers became much, much bigger. And this, at first, positive numbers, right? And then they stopped being positive all of a sudden. And then they became negative. And then, John Mack was on your trading floor all of a sudden. You're like, okay, this is definitely not a good sign. Like, this guy I've never seen except for on TV, right? He was the CEO at the time. Very famous guy on Wall Street. No, I didn't interact with him, but just seeing him, a few feet away from you, you definitely knew this wasn't going the right way.
Okay, so you start seeing
this is well before Lehman, by the way, right? This is all a year before Lehman at this point. So.
This is a year before Lehman.
Yeah, this is a year before Lehman.
So were the markets being alarmed, or was it just alarming at Morgan Stanley?
No, this was in the subprime market, right? And because the subprime market was the juiciest piece of the market, it was the one that had the most second generation securitizations attached to it. So most of the CDOs and so on, that the real carnage came from these second level securitizations attached to the stuff that originally was the juiciest, right? Because if you have the most spread to work with, you can structure more and, distribute more money around the structure, right? And that happened well before, as I said, at least a year before Lehman. That was already carnage in that world. Now, in the overall financial market, and even in the US housing and mortgage market, it was a relatively small percentage. I don't remember the exact number, but something like 15% of the overall mortgage market, maybe it was 20, I don't know, was subprime. So the overall market was still completely healthy at this point, and everyone outside of this relatively small world, even though the losses are starting to come in a big way, outside of the small world thought, that's those guys' problem. That's not going to affect me with my high quality borrowers and my high quality whatever I have, right? That was the
and real quick, the dumb question. Wasn't one of the issues that they were ranking subprime mortgages and finding a way to treat them as like class AAA rated?
That's right.
Bonds?
I mean, the very simple answer is, this may not be so simple if you haven't lived this, but is, so you, in these structures, you would tranche, right? And you would have, let's say, $100 of mortgages in them. And the top bit, so the best bit, would be 60 cents of that, or $60 out of the 100. And then the bottom would be different tranches. And when losses were allocated in the structures, they would come from the bottom up, as they said. So the first $5 would be wiped first, and the next $10 would be wiped, and so on and so forth. Now, somewhere in the bottom of these slimmer tranches is what was the triple B or double B tranche. So that was not the very bottom, but it was up a little bit. Now, what they then did is they took 100 of these structures and they would take all of the triple B tranches from these. And if you assume there is a low correlation between these triple B tranches taking a loss, because the different structures have different mortgages in it, right? Some whatever underlying borrowers, right? They're always different. Then you would come to the conclusion that it's extremely unlikely that all 100 of these triple B tranches get hit at the same time. So some portion of these, if you then again have this kind of structure where the loss is allocated from the bottom up, would be extremely high quality credit. And so that's how they created essentially triple A's out of these triple B's. Yeah. And it worked for a long time, right? It's not like,
it did.
It did work. And what essentially wasn't factored into any of these models is that the entire housing market in the United States would drop at the same time, because that had really never happened before, right? There'd be a savings and loan crisis. Texas was very badly affected, but New York wasn't, or San Francisco wasn't, whatever. Whereas in the great financial crisis, the entirety of the US housing market was affected. And so the correlation between these different deals, instead of being whatever 0.1 or 0.2, whatever the rating agencies were convinced of by people who had my job, I guess, to convince them of, it was more like 0.8 or 0.9. And that meant instead of having diversification between these deals, there wasn't any. So that's, yeah. So.
All right. So John Mack's on the floor, P&L starting to get negative, but you said there was like a year between that and Lehman.
That's right.
So what did that year look like for you? Were you just still on the trading floor, or did your job start to evolve?
So during that time in my specific world, what then slowly started happening is, right, people were losing money, people were getting fired, teams started to shrink, but equity markets were still getting to all-time highs, and people by and large hadn't really factored it into this dramatic situation that it then later became. And the two interesting elements for me out of that were, one, they stopped hiring new juniors. So, and the top ranks started to thin out. So automatically there were a lot fewer people available to do the work, and the work still had to be done. So I got more responsibility much quicker than in the more traditional way of progressing through your career. Because there would always be, a VP ahead of you or so on. All of a sudden, there might not be a VP or an associate ahead, and then you as the analyst have to fill that gap. So that was one. And the other was it started being the first time where you could where I saw that the mass of market participants really got it wrong. This was, if you had the seat that I had, it was very clear that really bad stuff is coming. Now, didn't know if Lehman was going to go bust, but I knew that Lehman had boatloads of this stuff and they weren't marking it correctly, because they had exactly the same balance sheet that Morgan Stanley had. If we're losing this much money, they should be losing equal volumes of money, right? Or at least equal direction, or Barclays in Europe, or any of the banks, right? They all had this. But that wasn't the general perception, right? It was a perception that this is a problem for countrywide mortgages and Morgan Stanley and various others. And that was a real eye-opening experience for me, that the vast majority of professionals, we're not talking about the guys on CNBC or so on that just watch it after they have their whatever job done and they come home at night. No, these are people who do all day long investments or markets related stuff, still didn't see this at all. And that was an interesting, just an interesting experience to see that can happen, because to make big money, that's the situation. I didn't realize it at the time, but that's sort of the first time I saw it, when the mass of people didn't see it.
So what did your day look like when Lehman went under?
To be honest, around that period of time, every day kind of blends into one. But it was some version of you'd come in, you'd have your book of bonds that you were supposed to tend to. There's an incredible news flow. All the stocks start dropping. Most of the senior guys, all they do is sit there and refresh the stock price all day long because 20 years of life savings is in whatever stock, in this case, Morgan Stanley stock, that they were working at. You didn't have this, right? Because you're brand new, so you have no real risk involved in any of this. You're just looking around, like everyone's losing their head, and you don't have a whole lot to do because there's no one trading, right? There's nothing going on. The market is frozen. The bid-ask spreads are huge. So you just sit there, and at the end of every day, you mark down your book, and it's another $10 million lost, another $50 million. At some point, it's just numbers with zeros on it, right? So it was an interesting experience, but you were mostly a spectator, even though you were in the middle of it. You're still just watching other people's reactions to it largely.
Okay, I'm going to spoil the ending of the story because we're going to get into talking about how we get to the end. But one of the things that captivated me the most is the story that you have compounded capital from about that period of time, $1 million into a portfolio today of about $250 million.
That's right.
And it started here. So I spoiled the ending, sorry, but now we're going to tell a really cool story. So the world's falling apart. You don't really have anything to lose, so you're just in the middle of it.
Yep.
Your team was 80 when you joined it.
Yep.
And then basically by the end, it was just you.
Yeah. In Europe, in between, I started in New York, but very quickly moved to London. Yeah. By the end, it was just me, and then there was another guy.
And when it was just you, what was your day-to-day and what thesis did you start forming?
So at that point, we'd gotten rid of the vast majority of the risk that was within this group, and other groups had passed on to us because we got pretty good at getting rid of risk. And what you could see then, so this was 2012, but what you could see over the last...
Oh, this was 12.
Yeah, I was there for 6 years. Yeah.
Okay.
Yeah, exactly. I was there for a long time. And I mean, partially, again, because there wasn't such a great opportunity outside, and partially because it was actually quite interesting, and I got a huge amount of responsibility early on. And I worked with, at the end, a core team that was extremely nice, good, smart people. Some of the best people I've ever worked with.
Yep.
And some of them I'm still very close to. And what you could see is that from 2010 to 2012, the job became a lot easier. Stuff stopped falling. Some things started recovering. It just was pretty clear that for the institutional size that I was living in at that point, the floor had been reached. I mean, that was amply clear to anyone at this point, right? I left then in 2012, and I guess what I then did, which is probably not what other people did at the time, is I took whatever very small amount of capital I had and bought the extremely uninstitutional end of this market, right? It's like bonds that were worth a few $1,000s here or there at that time, personally. So, yeah. And those had not nearly recovered as much as the institutional size of the market.
Why was nobody else buying them?
Because who the hell on Wall Street buys anything for $1,000?
But even individuals or smaller players didn't see it?
Well, I mean,
it was so complicated?
Not so much so complicated, but ultimately that let's call it that structured product world was relatively small, right? I mean, there's not that many people in the first place. The risk takers and the really smart people in that world at that point had done what I didn't, which was way smarter. What they did is moved into seats where they were able to use institutional capital to play in this market and use their knowledge on a vastly larger scale. And again, if you know what you're doing and you can deploy capital in the tens or hundreds of millions, you will definitely not waste your time buying anything for 1,000, right? That just doesn't make sense. So the amount of people who knew what they were doing and who were, in a way, stupid enough at the time to play in such small size was very, very limited. Whereas the amount of people, on the other hand, who held this kind of risk, who had absolutely no idea what they were doing, was relatively large, right? It's a small French bank or an insurance company in Germany that had literally hundreds of these bonds on their balance sheet that were all worth, a few hundred, a few thousand, or tens of thousands at most dollars sometimes. where do you go with that, right? They would give it to some small regional broker, usually a shop that looked pretty much like this studio, two guys and a Bloomberg kind of thing, and those guys would then try to sling it around, right? And there weren't many people at all interested in buying any of this stuff. I mean, there were some, but just not many.
We're a podcast studio by day and a clearinghouse by night in here. See all of our notes on the wall. And the thesis was, I can buy this stuff for pennies on the dollar.
Yeah. Not only I can buy this for pennies on the dollar, but I can buy it for a significant discount to where the same exact bond or risk would trade if it was an institutional size bond, right?
Okay, explain that. So like, what was the gap at that point?
So let's say one of those subordinated bonds, the entire, as they call it, tranche of that would be a $25 million tranche, right? And an institutional size would be trading $5 million notional at one time. That might then trade at this point in time around 20 cents, right? So it'd be $1 million deployed. But if you had a $30,000 notional clip of this, and that then, that just becomes so small, but it not only became small because of that, but the price was also less. So the 30,000 clip might trade at 5 cents, where the 5 million clip would trade at 20 cents, right? So a massive gap on the exact same risk. Now, you had absolutely no hope of ever selling that to someone unless a broker-dealer at that exact moment had exactly this bond. Then they would buy it, right? If I already have 5 million of it, sure, I might buy another 50,000 of it. But if I don't have it, I'm not going to bother even figuring out what I would pay for this. And so then that's why that part of the market just had not recovered at all.
So you just made good friends with some brokers and said, show me what I'll call it the cheapest bottom tranche sub-institution.
Show me whatever no one else is buying, whatever you've held, whatever you know that hasn't sold in the last month and has been sitting there, because you're not going to sell it to anyone else. So.
And at the time, did you was it one of those moments where you're like, I cannot believe I have this opportunity? Or is it, again, a hindsight thing where you realize how good it was? Or was it one of those moments where you're like, this is literally like free money?
No, it was so obvious. I mean, at the end, so I couldn't do this while I was at Morgan Stanley, right? But at the end, I even left a lot of money on the table leaving Morgan Stanley because I couldn't wait to get out and actually be able to buy this stuff.
Yeah.
So
And how long did that window last for you?
So I only was doing this for a few months because then I got smart enough. I was like, hang on, I should be doing what all the other guys that are actually smart doing and try to get a seed to do this with institutional capital and actually get that leverage, right? Because I only had a very, very small amount of money myself at that time.
Right. So did you end up doing that?
So I did that. What the effect of, so I did that, yes. I guess that's number one. I did that. And I joined a New York-based hedge fund who wanted to set this kind of business up in London. So I joined them to be their London mortgage-backed securities trader and built a business up. This was when the financial crisis in Europe, the sovereign financial crisis with Greece and so on, was going on. So there was, for a period of time, a good amount of volatility in the market and actually an ability to buy these bonds still. But what then happened is very, very quickly, because of the bank regulations, mostly Basel III, as they call it, made it almost impossible for banks to buy and hold any of these structured products. So the market then in Europe extremely quickly shrunk because no new bonds were created. And the old bonds, either paid off or they were bought by mostly US PE money who would hold them to maturity. So the actual investable universe between 2012 when I joined to 2014 when this more or less ended, shrunk probably by a factor 10x or so. It became almost impossible to do this as a trading job. So that was basically the end of my mortgage-backed securities trading days.
And how did you fare out on what you did buy?
So in terms of my work, those did well. The risk appetite that I had versus the more senior partners was different. As many Americans do, they view anything outside of the US as inherently way more risky than it may actually be in reality. And that's not a dig at anyone. I get it. Like, this is
we talked about
the greatest financial market in the world, right? By miles, and has a lot of advantages. But that doesn't mean everything outside is crap. But anyhow, So wasn't able to really put on that much risk. So that was fine, but wasn't a great success. The very small stuff that I held personally at that point was like what I generally bought was really long-term bets. So there wasn't much happening there yet. But then later on, those bonds returned like on average probably about 10 times, maybe more of the money that I invested. And that formed then later my seed capital for going into the real estate business, which was 2 stages later in my career at this point still. So, yeah.
Okay. We'll get there in one more question.
Sure.
The thesis though was my downside's pretty much protected. The odds of it going to zero are
very, very small. I mean, some of these bonds were paying, a quarterly coupon of like 1 point. You can buy them for 5 points, which means unless the whole thing blows up in the next 4 quarters or 5 quarters, you're making your money back, and then it's all free upside. And the one thing that I was extremely confident in is that nothing in Europe happens that fast. So if it's not it might blow up, but it won't blow up in the next year, right? And so that meant your downside was not in every one of these structures, but you do enough of these bets, and if you put 10 on, and you're going to be right most of the time, you're going to make your money back and have this great free upside, which generally then as I progressed through my investment career is, at least in my mind, the secret to great returns is having a very good free upside built into whatever you're doing. So.
All right. I'm dumb and I'm from Texas. Why does 1 year matter? So you said you bought it. Why does 1 year matter?
Very simple. So let's say a bond that had par value of 100, right? You're buying it at, I'm just picking numbers here, at 5%. So you're paying $5 for that 100. And it pays a coupon, let's say, of 5%, right? Well, but it pays that coupon on the 100, right?
Oh, yeah.
So basically after 1 year, you've made all your money back.
Oh, yeah.
Right. So because you bought it so cheap, right? If you pay 100, then the 5 points that you get makes no difference. But if you pay 5, then that's actually 100% of your money, right? So you don't have to do that all that often before you make your money back. And then everything else is basically free upside, right?
So basically buy so low.
In this
there's
case,
no downside and there's only sunny skies ahead. Okay.
Yeah.
All right. So then you go
and
on.
Spread it around a bit, right? If you do it once, you might still get hosed. But if you do it 10 times, the odds that all 10 go against you are just really, really low, right?
So then you go to the hedge fund. That lasts for a couple of years. Mm-hmm. And then what happened?
So because the trading world essentially disappeared in Europe, not exactly, but it kind of did. What I then convinced my partners, I guess in this case still, was that we need to go into the real asset world, right? Because this world that we essentially were the end point of started somewhere, right? Someone made a loan to someone somewhere and then repackaged it and sold it as a bond. Now, if the bonds don't exist anymore, and that's why we don't have our job, that also means the loan down the line doesn't exist anymore. And within Europe, especially, not only did you have this channel of financing for the economy and for the real estate business especially go away, but what you also had is that banks that used to have, I guess, 50 times leverage on their equity capital had to rein that into 10 times leverage, let's say, roughly speaking, which meant they couldn't lend as much as they wanted to anymore either. And within Europe, that meant that especially the European periphery, and let's say non-favorite sectors of the economy from a political perspective were extremely credit starved, meaning that if a bank still has lending capacity, they'll lend it to consumers, small, medium businesses before they lend it to a real estate developer, because that's not no one's going to blow their political capital on saying, hey, banks must lend to developers, right? Or professionals in any way, which meant there were pockets of Europe where it was literally impossible for people to borrow. And I thought, well, this is not exactly what I've been doing, but this is about as close as I'm going to find anything. And then must be opportunity. And lo and behold, there was. Yes. So then after trying a few things, set up a commercial mortgage lending operation in Ireland. That was the next step.
And how long was that window of you seeking and looking for that opportunity? A year? Or?
Yeah, probably at least a year, right? Because again, it's something that you've never done before, so I don't have any clue how do you do it. I have an inkling that there should be opportunity, but I've never made a loan in my life, right? So I don't even know what that means, to be honest. I'd never even borrowed at this point in my life. I never bought anything with a loan, so this is very far in a way, but still not a million miles, right? And then you go and you check out, fly to Greece, talk to a lot of people, like must be opportunity around here. And you do the same, go to Italy, go to Spain, and go to Germany. And anyway, it takes a while to sort of gather the facts and start understanding what matters to be a lender, right? For example, that the legal environment and the enforcement process in the courts is hugely important, which again, nowadays you look back and think, what else would matter? I mean, of course, that's one of the top 5 things for a lender. But if you hadn't dealt with the actual enforcement side of a loan ever, it takes you a while to figure that out. Right? So, take me at least a year to go through that process. Yeah.
Okay, so you set up a commercial lending for Ireland.
Well, at first it was supposed to be a bit more pan-European, but very quickly I realized, well, it's just me by myself here. So language barrier in Europe is always an issue. I do speak English. I speak German. That's it. So trying to do loans in Spain without speaking Spanish, already challenge number 1. But then also generating the deal flow and dealing with some of the back end of a lending business. Ireland was the obvious choice for 2 things. It was completely empty. There was no one lending at all. And the legal environment from a lender's perspective is, for a European country, lender friendly for professional lending. If you lend to consumers, different story. But if you lend to professional investors, you can enforce without having to go to court or deal with a lengthy process. Not always, but generally.
Yep. Okay, how much did you raise?
So started with 100 million. That was actually supplied by the firm that I was still with at that time, even though I wasn't doing that much of the mortgage trading. They supplied that, and then raised, I'd say, another 200, maybe 250 on top from various financial institutions. So overall, maybe 300, 400 million that we then deployed over a number of years this started small, right? You don't start day one and all the money is out. You make a loan here, you make a loan there. But from 2014, over a period of 2 years, roughly, we deployed that. And then it went afterwards for a little while, but my active involvement then scaled down massively at that point because I sort of set up the team. And at some point, people who are on the ground are going to do the job better than you flying in from London and, running around town or around the country trying to do it for them. But yeah, so roughly that month.
So you started 2014, like you said, didn't really know a whole lot about lending.
Yeah, it was probably actually in 13. I mean, it's like all these things are fluid processes, but yeah.
But if the question's really like, what are like the key takeaways by 2016 that you're like, okay, I understand, like, here's something I learned in the lending business that you can only learn by being in the lending business?
I mean, there's a lot, right? Every time I went through a career change, there was a lot. And every time I did it, I thought I knew a lot more than I actually did when I went into it. But it starts from simple things that are directly related to the lending, right? How do you actually, what's a loan document look like? I mean, it's a professional loan document in Europe is an LMA, London Market Association, or I don't even know, but it's called the LMA, which is what the London big banks and the London market uses. That's the standard template. That's a 100 to 300 page document, right? You got to learn how that works. Then you have to learn how enforcement works. You have to then learn what a borrower actually cares about, what you care about, what your back leverage cares about, right? Because you originate the loan and then you have to give it to another bank to give you leverage on that. So you have to make sure you not only understand their docs, but that they're happy with the docs you do. So that takes a while to learn. But in parallel, and this is what was extremely valuable for me, is you also learn about the actual asset that you're looking at, right? At first, my approach was very much, this is a spreadsheet and this is the rent coming in and this is the square footage of the building. And this is, basically done at this point, right? But then you learn, rent per square foot in this location is not the same as one that might be only 100 meters or 100 yards down the road. You learn that ceiling height matters. You learn that sometimes people don't pay the rent, even though it says, on the contract that they do. And many, many little and big things like that. You also learn that it matters a lot who you lend money to, that the making a loan work from a lender's perspective requires a borrower that can pay and that wants to pay. That's not always the same thing. And to be honest, it was for me a combo of learning about the real estate business, learning about mechanics of lending, but also about people. Like so far, my interaction with people was pick up the phone and say, hey, make me a market on this. And the guy said, whatever, 25, 26. And I said, yeah, bought, sold, whatever. That was the extent of the interaction, right? There was not a huge human element involved. But when you're doing business in the real world, there's a massive human element involved. So yeah, it was a crazy good lending experience for me.
Okay, so I'm going to take a stab and guess that you started lending into Ireland, and that gave you the wisdom of maybe I should start buying property in Ireland.
Essentially, that was sort of the transition, right? There was twofold. One is because the lending business was started when I was a partner of another firm, my economics were not all that great relative to the success of the business that I built. So my took a little while for me to figure that out. But once I'd figured out that I'm not going to make nearly as much money as I should of this situation, that was one element of my motivational change. But the other was realizing that people were paying a huge amount to borrow from this business that I set up was called Origin Capital, to borrow from Origin Capital for relatively low risk loans that, you know, someone in Ireland was paying, let's say 8%, when the exact same, not exact same, but a very, very similar setup, a similar situation in Germany would have paid maybe 2%, right? And I thought, well, these people aren't all idiots, right? So I looked at what were they actually doing? And in many cases, they didn't care at all that they paid 8%. They would have paid 15%. Because it didn't matter. They were making so much money on owning and being able to buy the real estate that, of course, they would have preferred cheaper. But buying it was all the game that mattered at this point in time for them. And so I thought, you know what? I'm going to exit this situation here where I'm capped on the upside, and maybe I'll join the borrower side of this world and start doing real estate deals myself. Yeah.
Okay. So you leave Origin.
Yeah.
And did you know where you were going to buy in Ireland? Did you have to spend time kind of figuring that part out?
Yeah, it took a while. Again, you think, all right, I've been on the other side of the table here for a while. I kind of know how this is supposed to work. And then you start, trying to actually get a deal done. You discover, wow, there's 1,000 ways a deal can die. And I've learned another one today. And, that that happens over and over and over again. Again, there's a little bit of a fluid transition anyhow, right? Because for a while I was staying on as a consultant, making sure that the Origin world was working and so on. I wasn't actively involved in it, but just making sure that everything was going all right. And I was still in many ways a deal flow generation for them because I'd been doing it for so long. But on the deal side, it took me at least a year of running around and, as they say, kissing lots of frogs and just trying to figure it out before something then came around. So it was, again, a protracted period of trying things that didn't work, I guess. Yeah.
Okay. I know there was, take me through like a series of the deals that you've done, because as I understand it, now you're one of the largest commercial property owners in Ireland.
We are one of the largest potential developers.
Correct. Yeah. That's right. How did you what was the first deal that we finally said, okay, I found something?
So there were a whole bunch in the beginning that all sort of happened relatively in quick succession, but I'll pick one that's a good example of what we did, why it worked, and how it ended up playing out.
Is this the one with the meth lab in it?
That's the one
we can tell now.
With the meth lab in it. That's the more entertaining, but really not that important part of the story. And I'm wearing a collared shirt here today, and I said this is the more serious version of me.
Okay.
So, essentially, a lot of this is in and around the city of Dublin, which is a wonderful place. If you haven't visited, definitely put it on your list.
Home of Conor McGregor.
It is home of Conor McGregor, and Guinness and leprechauns and the whole thing. But it's a really, really nice place to visit. And Dublin has a couple of things that make it different from an American city. Not a million miles different from other European cities, but for you guys, definitely interesting. So one is the center of Dublin is the largest, I think, if not one of the largest areas of Georgian architecture, which is a period of the British Empire where the Georges were the kings. And so that's all historic preservation. So you can't build in large swaths of central Dublin. At the same time, you do have a growing population on all fronts. You have domestic birth rate that actually is above replacement rate, which is unusual in Europe, and you have immigration. And those trends have been going on for a while, and which meant that there was pressure already, even though the market was still very subdued, but there was pressure for accommodation and building space of all sorts. Now, one of the first areas that experienced it post the financial crisis was student housing, because it wasn't directly connected to the domestic economy, right? If you're a foreign, in this case, almost all were foreign students living in student housing, it didn't matter that much what the wage level or so on was in Ireland, because, well, you got paid by your parents, right? And they were making money wherever else they were. But there was very little student accommodation at that time available, especially not the purpose-built, which is, any normal dorm that you think about just didn't exist in, at least not in large numbers. But you had a big inflow of students. Now, there are parts of Dublin that had historic industrial or commercial uses that don't apply anymore today, or are becoming less and less important. One part of Dublin is what Dublin has done, like many cities, by postcodes. So Dublin 8 is where historically the Guinness Brewery is. It still is there, by the way, and a bunch of sort of industrial adjacent things were. We found this this property, and by we at this point, that was just me, really. Yeah, and I got a call because during this period of time, and really to this day, when you have a reputation for doing what you say you're going to do, for closing deals on time and performing, people call you when they hear about things that might where that element might be really important. So this was one summer, I got a call from someone, I forget exactly what it was, but it was in the end of July, right? And I get a call from someone who had met via a previous deal, who said, "Hey, I know this guy. He has he has exchanged in our building. He has 10 days or 14 days left to close." And as I mentioned to you before, the market structure there is you exchange on a contract, you put 10% of a deposit down. That's hard money. That's gone if you don't close. And then when the closing date comes, you close or you lose that money. And so this guy was past the period of time where he had already put the hard money down, exchanged, but he hadn't closed yet. And he had 14 days to go. Maybe it was 18, forget exactly. And that's an extremely short period of time left. So I never met this gentleman before. I've worked for many years now with him. Never met him before up until this point. But I was in Dublin. I said, "Yeah, well, it's fine. I'll meet him for a coffee." Met for coffee. And showed me the property then later on. And it was a rundown furniture factory. So industrial building, but probably rundown. But in a part of town that was sort of up and coming at that point already, in Dublin 8. And because of that very short timeline, I was able to get a good deal on it. He had already gotten a good deal. I got a slightly better deal from him. We had an agreement that worked for him as well. It wasn't totally one-sided, but I got a good deal because of a very short timeline. And it was essentially a land play, because the building itself was in bad shape. Now, it could have been fixed up and probably done something with it. Of course, it could have been. But the real value was as a land play in this piece. The zoning, like everywhere, is slightly nightmarish, but you have zoning that is essentially concentrated to generate employment. This was one of those. So
What's that mean?
Basically means whatever happens on this piece of land should employ people.
Yeah. Okay.
I mean, historically, it meant manufacturing of some types, right? In these kind of locations. Now, what we figured is, well, there's this big pressure on student housing. There's, the first international student housing groups moving in, looking for, things to buy. I was like, student housing, you need a lot of people to run student housing, right? It's a not too dissimilar from a hotel, right? A little bit less hassle, but it's in that direction. So we made the argument during the planning process, which is what they call the entitlement process over there, to allow us to put student housing onto the site. That ended up being successful. The overall play, by the way, ended up not being successful because within this planning play, there was a land aggregation play, and we failed in the land aggregation. This was one of my many learning experiences where I just didn't realize how to really pull off land aggregation. But in any case, because we bought it right and we managed to get the planning through, we made about 4x return on this in about 2 years. While that value was being created through the planning system, about halfway through, we managed to take our money out of the deal and buy the next deal already. Slightly bigger, about twice as big in terms of investment volume, but similar kind of idea. And so what we then did over a number of years is buy properties and add value either by changing the zoning or the planning on them, or leasing them up, refurbing them, whatever, right? I mean, to some extent, what you guys do with Class B industrial. But we did, because it's a smaller market, less focused. You can't just do one type of asset, or you go for long periods of time without doing anything.
And you just, I don't want to skip over that one part. You said we pulled out some money to go buy the next one. Mm-hmm. What happened there?
So we essentially found a lender, not too dissimilar of a type of organization that I had previously built, right? So I knew a little bit how they work. We paid them an extortionate amount of interest, but we got more money on that loan, a non-recourse loan against this asset, than we paid for the asset. So in that sense, we got all our capital out and a little bit of profit. So that became a free option at this point on. And we took that capital to buy the next property to do the same thing. But that next property then was unencumbered, right? Because the debt was on the previous property. So property number one, which then meant on property number two, we could do the same thing. You can't do it right away because it's a bit too blatant, but you add a bit of value and then you can do it then again. And so we did that one, and you do that 20 times and the numbers become bigger and bigger. And I guess here we are, right? So
what did adding a bit of value look like? Was that painting a building? Was that
no? I mean, look, normally you have to transform the value in a way where it's not like you can just
or was just buying it so damn cheap.
Partially it is, of course, you have to buy it right. But the other element is oftentimes it's during this period of time, the vast majority of bad real estate was owned by people who either didn't care because they were so far underwater on their loan. So this next property that we bought, I don't know the exact numbers. We bought it from a seller who essentially got pressure from one of the PE houses who ended up buying the underlying loan to get rid of it. And my best guess would be is that he probably owed 3 or 4 times the value of the property to the lender.
Yeah.
Right. Which meant that for a long time, this owner just didn't care what happened in the property, because what difference does it make? You're not going to recover any money from it anyhow, right? So a lot of these owners focus more on putting, for example, really, really bad tenants in, but then getting those tenants to pay the rent in cash and then pocketing the cash. And, that's how they got money out. Now, I'm not accusing anyone of anything. I don't know anything, but that was a strategy, right? Which then meant, by definition, after a number of years, right? So this is 2016, 17, 18, you're closing in on 10 years of this kind of behavior. You have really crappy tenants in some properties. I mean, like, that just haven't paid rent in years and like everything is going badly. So sometimes it's as simple as showing up, getting rid of those tenants. Now, it's a process. Ireland is a relatively tenant-friendly jurisdiction, but you can over time get rid of them. And then putting tenants in that actually pay the bills. So that sometimes it's that simple, At other times, it would be shoddy construction that had fire regulation issues, and hence you weren't allowed to rent a unit or many units or apartments or whatever it may be, right? Fixing that, sometimes that's easy. It's putting fire alarms in or stuff like that. Sometimes it means you have to strip back a building and fix underlying fire separation issues. Sometimes a combination of all that. Now, again, not rocket science to do, but if you're either a bank that's foreclosed on a property or you're the owner of a property that's so far underwater, again, you're not going to do that. Why bother with it, right? So, again, it does add real value, but it's just not rocket science, right? And so we would do this, whatever the relevant strategy was, and then overlay it oftentimes with getting planning permission to do more with the property than was already there.
Okay. And real quick, just on loans, do loans in Ireland usually mimic like a type of loan you get in America? It's got a set term limit.
Yeah.
Are they fixed? Are they floating?
So normally, it depends a little bit on the size as you're playing. The smaller it becomes, so the more retail it is. That's up to like maybe $1 million or $2 million. But once you're past that, it's very similar to the US. Not similar to all parts of the US, but it's a 5 years standard term. You can borrow somewhere between, depending on who you're dealing with and what you're doing, 30 to 70 or 80% with some mezzanine kind of stuff on top. And it's a floating loan back in the day, all over, no, actually in Ireland, still all Euribor based. So Euribor still exists, which is basically like LIBOR used to be, except for euros. Right?
Euribor.
Euribor. Yeah.
Okay.
Yeah.
All right. So, well, fast forward. Yeah. How much have you assembled today? Like maybe you can give me the total size of it all, but then really like, what are you capable of doing with all this stuff?
So what we focused on is for then the tail end of our portfolio growth period, which lasted roughly till about COVID hit. And then we took a bit the foot of the gas pedal. The bulk of the portfolio then was assembled in the few years leading up to that. We have roughly in Ireland about 200 million euros worth of properties. It's roughly split evenly into sort of standing stock and so investment properties and development properties. We can build, and this is in various stages of the we can build process. Some we have full entitlement to build for about, call it 1,000 apartments. And then we have various sort of future phases that are further down for another, let's say 3,000 apartments and homes. So we can build about 4,000 housing units on our estate. And we have, I guess, about 800,000 of industrial standing stock. And we have 150 apartments roughly standing stock at the moment.
Okay. And then let's just go back for just a second. Part of the thesis, as we talked about today at lunch, from Ireland from 2009 to 2019, how much development happened?
Almost nothing. I mean, very, very, very little was built while the population was growing throughout this period of time. To the point where, just to put it in context, the entire island of Ireland is split into two jurisdictions. The north is still part of the United Kingdom. The south is an independent country. But if you add all of it together, it's about the size, population-wise, of the Dallas-Fort Worth metro area. So it's not a huge place. In the Republic, there's about a bit more than 5 million people, about 2 million households, and a housing shortage, which the numbers depends on who you ask or so on, somewhere between 200 and 250,000 units, which is really staggering in the context of only 2 million households to begin with, right? And that is largely a result of one, population is growing, the economy is doing exceptionally well, but you have a 10-year window, and it's still sort of persisting, although it's getting better. But for a 10-year window, literally nothing, almost nothing was built.
And layer in, what's the tax regime look like? Like, why is it a hotbed for big pharmaceuticals, big tech companies to come?
So there's probably three elements to it. Okay. One is the tax rate. So if you're an operating business in Ireland, you pay, going forward, the global minimum tax, but historically 12.5%. Two is it is English speaking and is relatively similar business environment to the United States in the sense that it's common law. And England, by the way, would be the same. But England is not in the European Union anymore. So it makes life a lot more complicated if you're manufacturing, exporting anything. And then the last is it's an exceptionally welcoming place for foreigners. Almost all Irish people, especially ones who are sort of my age and older, have either lived themselves abroad, have a brother abroad, period of time spent abroad, wife, cousin, whatever. It was an emigration-focused country for a really, really long time. And thus is really, I mean, especially for a European country, again, in the US, people are so polite and nice generally to strangers that you might not appreciate that. But in Europe, that's just not generally the case. And Ireland is a really welcoming place. especially for Americans, especially for, well, I mean, really for people from all over the world, to be honest. So it's, and it makes a huge difference when you're deciding to, well, where am I going to put my headquarters, right? I can go where they speak English, where the tax rate is low, and people are nice. And it's not even far, so.
So you have growing population,
Yeah.
great tax setup, very friendly to foreigners.
Yeah.
Zero development over a 10-year period.
That's right. Yeah.
So then 2019 comes along.
Yeah.
What was the domino that kind of got things going, or was there a change in law, or it was just time? So
I mean, you have pressure and pressure build up. To be honest, it's only marginally changed. What has happened is in 2019, 2020, you saw a lot more influx of foreign capital. German pension funds started buying stuff and so on. That's died again, by the way, now because interest rates are up much higher than they were even 3-4 years ago, right? As everyone knows. So that bit is gone. But it's really just the market had started correcting itself, and now that's dampened again because the availability of financing has shrunk. Now the government is stepping in at the moment. Over the last 6 months, over the last 12 months, they've started doing a lot of project, and both for financial assistance and also to make the development process and the entitlement process more efficient, because that has gotten to the point where it's extremely hard to navigate. We're really good at it, but even our timelines have extended massively. But it is still, I mean, by far the number one issue in the country is the shortage of housing and space, both also for industrial users, but obviously more people are touched by the housing shortage. It's by far the number one political issue.
And maybe I've just missed a little bit, but why is it not getting done?
Well, so you have two effects, and to be honest, I'm always surprised by how long-lasting they are as well. But when you think about it, those two effects, I think, it makes to some extent sense. It's still surprising that it's so long. One is during the financial crisis, the banking system collapsed in Ireland, and you went from 16 or 17 banks that provided lending to development and to investors in the real estate field to all of those banks. And I mean, all of them either leaving the market or going bankrupt. And then you were left with two government-controlled banks because they were nationalized at that point. They're slowly being, denationalized. I guess the stocks are being listed and sold off. But those two banks are very, very cautious. And they are the big players in the domestic market. And their focus up until very recently, at least, had not been to provide financing to developers, because that's inherently risky. It's especially in a country risky where the villain and the reason in the popular mind for the financial crisis was developers who had overextended themselves. Sort of what, the Occupy Wall Street, they didn't have it, but if they had an Occupy Wall Street, they would have been an Occupy developers. That's I guess a good way of putting it. And that situation is persisting for two reasons. The more adventurous capital oftentimes is, and I mean on the lending side, right, is PE backed. So there's a certain return level that no matter who it ultimately is deploying it, they all receive the back end capital from someone who either is a PE house or has return expectations of a PE house. So that means you have to charge a certain level, right? So that's the flexible capital that is there, but has high return expectations. And the cheap capital that you have available in other places in Europe, like France, Germany, Italy, is bank capital. And when you think about it it's sort of an institutional failure of the European market structure, that if I'm sitting at Deutsche Bank in Frankfurt, for example, and I want to make a career, I want to push something new, I have the choice of, starting a business in Japan. Pick it, right? Huge country, massive opportunity. If it works, I might become CEO one day, right? Or I could go and suggest we'll do Ireland. If it works, it doesn't move the needle. Yeah, okay, I'm the guy who developed something in a not such a big place, right? It's not going to make me CEO for sure. If it doesn't work, I get fired. So I'm just not incentivized to do that. And that's to more or lesser extent the case all over the place. So that's one issue. So financing is still significantly harder to get and more expensive in Ireland than elsewhere in Europe. That's the part that the government is addressing at the moment. It takes time, and it's not an easy fix. The other element is that because of the depth of the financial crisis, and it was basically a country that was hit harder than Las Vegas, right? But the whole country, right? You had a lot of people who knew or who know how to do this business leave the industry, right? They moved to the US, they moved to Australia. They just called it quits and retired. A lot of businesses went out and they never came back. So you had a loss of, I guess, Ben Bernanke wrote a famous paper about this non-monetary factors of the Great Depression. You had exactly this happening in Ireland, right? You had the talent disappear and you had the financing disappear. And both of those things take a lot longer to come back than you would expect. There's not that many people where, like me, I guess, where the opportunity is big enough to spend their time and a huge chunk of their life trying to bring money and develop things, right, from abroad. Irish people obviously are passionate about their own country, but it's hard to do when you don't have the capital available, right?
I'm so rooting for Conor McGregor to become the president of Ireland. All right. You've bootstrapped.
We actually owned the gym where he trained.
You do?
For the Floyd Mayweather fight for a long time. Yeah, the mural is still on the wall of him knocking Mayweather out. It didn't happen, but that's what he was training on. Yeah.
Oh, that's awesome.
Yeah. So,
have you ever seen him in person around Dublin?
I've never met him in person. I've met a lot of the people he worked with, his trainer and so on.
Okay, so we've bootstrapped to today.
Mm-hmm.
And why are you deciding to basically go and raise money? What's the plan? Why is now the time? And what's the plan for the money that you're trying to raise?
Well, so I guess two parts to it. One is that the historic way of how I built the business is something that is much harder to do when the market is not on fire, because if you keep leveraging up and something goes wrong, then you're going to have a problem. If the market is on fire, then you can do that, because even if you do something wrong, you're probably going to get bailed out by the market. And that's fine as long as you're very confident in that. Now, I do think the market will eventually come back, and it is an attractive demand supply imbalance. I mean, it's crazy from a provider of the product, right? But that's not something that we want to keep doing. And much more importantly is, because we have this relatively large estate, we need to focus on developing that out. And we can spend in excess of $1 billion just developing that out. That significantly exceeds our current financial means. But at the same time, we've put together a team, and like a lot of this stuff in detail is done by my team at this point. A really good team that can find deals, that can take things through the planning process, and that can actually build stuff. And we have no capacity to fund that now because we're done with what we have. So for the next 10 years or so, right?
And if you build it, the stuff you're building, will it be market rate, or is the government put out something that gives you confidence or security that if you build it?
So there are a lot of different elements to it. So it depends obviously on the asset, but essentially because of the supply demand imbalance, the government is and has been putting out programs that that essentially put a backstop into the market. So if you're building housing, especially if you ran into a situation where you can't find a private takeout, and you wouldn't start building without a private takeout of some sorts lined up because you couldn't even finance it, then you will find either a social housing project, an affordable housing project, a government agency that wants to rent it or wants to buy it. That is the main part of the business at this point. And then while that is going on, over the next few years, at some point, the actual, let's call it, private market will come back, which in certain pockets, obviously, it's persisting. But as a whole, it's challenging. Now, what is totally working is individual houses. the apartment market is where the government is the main player at the moment. Yeah.
Is there any private development going on right now?
In apartments, there's very, very little.
God.
Yeah, very, very little. Even though there's a huge shortage, and within again the city of Dublin, it's the only efficient way to provide housing is obviously apartments, right? Just because the space.
The dumb question is: the city of Dublin the size of DFW, or all of Ireland?
No, all of Ireland, the entire island, right? So.
Yeah. I'm such an idiot. If you had asked me, is Ireland a island or not? Yeah. I would have probably said it's not.
Well, it's really interesting history. I'm a history buff, but it has really interesting history. As in, for example, it is the only country in Western Europe where the population today is smaller than it was in 1800. All other countries, the population today is vastly larger.
Why? Because they drink so much Guinness and just...
They had a huge famine. The Irish famine maybe rings a bell. No,
I didn't even know it was an island. You think I knew?
I don't know.
All right. So when was the famine?
They had a massive famine in the 1800s, early 1800s, and they had huge waves of immigration. That's why Boston, Chicago, and so on is full of Irish, because they left post. I mean, not just during that, but there's massive immigration out of Ireland. Then from that point until probably the 1990s.
And it's growing again.
Now it's growing, and now there's actually net immigration, and has been for a long time now. But
so I know Apple has like a campus there.
Yeah.
I think Google.
Yeah.
So when they bring thousands of employees in, where do they go?
Well, at the moment, they're really struggling. Yeah, and they have been struggling for a while. I mean,
and so you couldn't go to Apple and be like, hey, I need a loan. I'm going to build you 2,000 units of housing.
You know what? I had not thought of that. People have done that now with energy. There's a massive boom in data centers over there, like everywhere else. But in Ireland, even more because of the big tech industry. And for example, Microsoft or so on have started doing deals directly with people who develop solar farms or so on, sell them power directly, because the power grid for the whole country was sort of tapped out. Yeah. They couldn't accommodate any more data centers. On the housing front, I have to admit, I hadn't thought of that. It's not historically how this works.
Yeah.
The biggest challenge with it probably would be is that in Europe, if you as a corporate take on responsibility for something, then you kind of own it for the rest of eternity, right? So if you start housing people now, I suspect you're going to have to house them for the next 100 years. Maybe Apple, so profitable, doesn't care, but usually companies don't want to take on, liability. They've been shedding liability, generally speaking, whenever they can. So,
well, Tim Cook, if you're listening to this and you want to fund a couple thousand units of housing,
well, we'd be happy to work with you.
Yeah. So you would raise the money, and then is it pretty reasonable that the funding, the actual debt financing, would be available to you, or would that be a challenge?
No, that's something we can definitely do with these things.
Oh, cool.
Yeah, that's fine.
And that's because the lending markets are opening back up, or because?
I mean, once you're a certain size, things change a little bit. Okay. So if you're borrowing large enough amounts of money, you can go into the Frankfurt market, the London market, and you can borrow from that. It's tough to do below a threshold. Like if it's less than 50 million, maybe occasionally 25, then it just doesn't work. It's not worth those people's time. So once you're through that, then funding becomes a lot easier.
Okay, so if you raise the money and you can pull the financing in, just from my little knowledge on Europe and in some of our discussions, a big part of this, though, is can you get stuff entitled? Can you plan? I don't get the sense it's as easy in Europe as it is maybe in America to get some of this done. Maybe it is, but y'all have built like an expertise around this. So if I'm giving you dollars, one thing I want to know is, everybody wants to know in development, is like, can you get this stuff approved?
Yeah.
How do you think about that?
So I have to say, I'm not an expert by any means how it works in the US, so it's hard for me to compare. What for sure is a challenge in Ireland is that the planning system is become much more litigious over the last few years. It's much more contentious. As I said, the entire topic of housing is a much more contentious, much more political hot potato. And one of the wonderful elements of it, and somewhat insane elements when you're not used to it, is anyone can object to anything. So you want to build a house on one side of the country. I live 300 miles away, I can object to.
Sounds smart.
Even if it's in an area that is designated for housing, I can just object. I don't even need a reason, right? And so that's the first starting point. Now, that doesn't always happen, but happens often enough. And then there are several layers to go through the process where you can object and object and object, and eventually you can sue to prevent the development. Some people have turned that into a business, by the way, right? So there's crafty people who object in order to then extract a payoff. But that entire process is quite lengthy. It's very expensive. Taking a large, let's say 500 unit development through planning can cost you easily $500,000, which if you then don't get it, it's just gone. So it's a challenging, expensive, time consuming, tedious thing that's often not the most pleasant experience in life. But that's also why we do it. And that's why it makes money, right? I always tell my team, if it was easy, everyone would be doing it and we wouldn't make any money doing it. Now we have 100% success rate on quite a large number of projects. If you're willing to engage with the process and to follow all the steps, to engage with the stakeholders, you can reduce the number of just people who object. You can then work with the municipalities and the city, often case the city of Dublin, but there's many layers of local government interacting in these things to get their support, which then also helps. And last but not least, you need a really good legal team that when someone does come and tries to wreck your plans, then you can fight back, right? And so over quite a long period of time and lots of scar tissue, we've managed to do that very successfully. And then once you have that, then you can go and get the financing, and it's not that easy afterwards either, but you can then make it happen. Yeah.
People have asked, they said, Chris, you've gotten gray at an early age. What happened? And I'm like, I used to do entitlements and development. The main reasons why people in America hate it is traffic and like blocking of good view or something, which is totally subjective because people's idea of a good view could be, I used to be able to see over my fence. Now I can't. Is there any other reason in Ireland people will tend to, besides the people doing it for fraud, are there any other reasons why people usually push back?
Oh, there's, they might not like the color of the walls that you suggested. There is, for bigger projects, you have to do, you have to engage with the people who run the cell phone network because you might interfere with their cell phone signal. You have to deal with the traffic people, the water people, the electricity people. All the neighbors, people object because there's a school down the street and they think that, if people move in here, then the school gets overloaded. There's, the 10,000 different environmental elements that you could mess up. We recently had to do a bat study for an industrial building where I'm not really sure, there are no bats, it's not like an old bell tower with bats in it or anything, but I didn't really know exactly why. You have to deal with someone might not like the amount of light that falls into the kitchen in your proposed development. And you say, well, but you don't have to live in it. Why do you care? But that's all irrelevant. You have to justify all of these points. The noise that you might be generating, the noise that the wind might be generating, howling around your structure, traffic that you affect in another country potentially. Again, Ireland split into two jurisdictions. It's really quite fascinating in a way, even though sometimes it's the most frustrating thing you have to deal with.
Yeah, I think if anybody's listening, it's not in development. I'm botching the story a little bit, but there's like a $400 million or $4 billion development in America that's like not getting through because it endangers like a species of frogs or lizards. I can't really remember.
Yep.
And it's this one really loud environmental group, and it's crushing this whole development to save like a frog.
Yeah. Yeah. And that exists. And then you sometimes have to get in specialists that count a certain type of bee that is flying around. Another element that maybe you don't have as much in the US, but that is big in Ireland is archaeology, right? So you have to dig. And if you find, by, in this case, good luck or bad luck, depending on which side of the equation you're on, a Viking helmet, well, then maybe everything is on hold for the next 3 years because you have to excavate the entirety of the site and see what else might be there, right? or you find a human bone, then who knows what happens, right? It has to go get the police involved, get the archaeology people involved. That might take 3 months just to analyze that bone. I mean, it's the amount of stuff that can go wrong or delay you is quite fascinating in many ways. But it's all manageable.
It is all I mean, I'm telling you, it's as much an art and a gift of how you get these things through. I truly believe you could have the same piece of land and multiple groups go about it in their own strategy, and one's going to get it approved and one's not.
And your team matters a huge amount. I mean, that's your internal team, your external team, your architects, your planning consultants, and so on. I mean, for a big planning application, the forms, the filled out material that you submit might be 1,000 pages, right? So obviously, I hardly know what's going on with this stuff. But it's really, really important to have a really good team around you on these things. And fortunately, again, over the years, I've managed to do that.
So if you get a deal done or you raise money, are you just going to contribute property into a fund, or is it kind of open-ended right now what it'll look like?
That's quite open-ended. I'd say it's driven by what people expect. Contributing property, I guess, has a transfer pricing issue attached to it, which historically I would have just said, look, I'd rather not go through that brain damage with someone, because someone is going to complain later on, right? It's just always the way it is, even if they're happy day one. But it's relatively easy to segregate projects, So, from this day on forward, new projects are new projects and the old ones are old ones. So I think that's quite all right, actually.
All right, man. I'm bullish on Ireland.
It's a wonderful place. Yes. I highly recommend it.
I need to come visit someday.
Yeah.
Thank you for joining me today.
Thank you very much.